The ghost capital, inside Indonesia's 160-year gamble to move a sinking nation. What happens when a nation decides its capital city is simply beyond saving? In the northern coastal districts of Jakarta, the ground is literally giving way beneath the feet of over 10 million people, forcing an unprecedented multi-billion-dollar exodus to the jungles of Borneo to fund a city that has barely arrived. This isn't a story about a routine administrative move. It is an extraordinary high-stakes gamble to relocate an entire empire because the soil beneath it is liquefying into the sea. But as the concrete begins to dry in a brand new capital, a critical financing gap is forcing the state into an unusual strategy. It is selling off pieces of the infrastructure that already works. On the island, it is trying to leave. Act 1. The city running out of time. The crisis at the heart of this narrative is unfolding in real time along the edge of the Java Sea. For decades, coastal northern districts of Jakarta have been fighting a losing battle against the water, a struggle that has left the realm of environmental theory and entered the daily lives of factory owners, shopkeepers, and families. Foundations are cracking, coastal roads are regularly submerged, is running out of time, and the government has arrived at a conclusion that will reshape the geography of Southeast Asia. They cannot engineer their way out of this disaster. They have to walk away. The underlying data reveals the staggering scale of the structural collapse. According to figures compiled by the National Research and Innovation Agency, known regionally as BRIN, Jakarta is subsiding at an average rate of 3.5 centimeters every single year. But that average masks the extreme danger concentrated along the coast. In the northern littoral zones, the soil is dropping by up to 25 centimeters annually. It is a rapid, silent descent that normal municipal planning is entirely unequipped to handle, turning prime urban real estate into an unstable fluid basin. Look at the historical trajectory, and the numbers become even more alarming. Over the past 4 decades, the northern fringe of the metropolitan area has dropped by a massive 4 meters. Today, 40% of North Jakarta sits entirely below sea level, transforming the district into a volatile flood basin that drains the regional economy of an estimated $186 million a year in direct damage. This isn't an abstract statistical loss. It is measured in ruined commercial stock, rising insurance premiums, and the slow, relentless erosion of generational family wealth. But the water is only half the problem. The city is also choking from within. The massive gridlock across Greater Jakarta, a metropolitan expanse home to over 30 million people known locally as Jabodetabek, inflicts an annual tax of between $5 billion and $6 billion through wasted fuel, lost productivity, and severe pollution-related health costs. Private vehicles overwhelm the system, accounting for 80% of all daily trips. Meanwhile, formal public transit infrastructure handles a mere 11%. The city's transport network is fundamentally broken, running at absolute capacity until the next downpour hits. When those heavy tropical downpours inevitably strike, the entire arterial road network paralyzes. For ordinary commuters, the consequence is immediate and punitive. Ride-hailing fares routinely surge by up to 400%. A single trip home that usually costs a modest sum can suddenly demand a quarter of a day's wage for a frontline nurse or a delivery rider. For millions of residents, this isn't an occasional urban inconvenience. It is an exhausting daily financial penalty for simply trying to survive in a metropolis that is slowly drowning under the weight of its own infrastructure. This double crisis of relentless coastal sinking and terminal urban gridlock created an unsustainable burden on the national ledger. The state apparatus arrived at a historic, radical crossroads. They realized that incremental municipal engineering, elevated seawalls, and localized transit fixes could no longer manage the decay of Jakarta. The problems were compounding faster than the solutions could be deployed. So instead of spending the next 50 years fighting a defensive losing battle against geography, the government made a definitive choice. It decided instead to leave. Act 2. 20% on the books, 8% on faith. The decision to completely abandon the historic center of Indonesian political life required a decree of unprecedented scale. The construction of a brand new capital city, IBU Kota Nusantara, carved out of bare forest land over 1,200 kilometers away in East Kalimantan. This moves the entire weight of the state off the crowded, sinking island of Java and onto the rugged topography of Borneo. But building a hyper-modern metropolis from zero requires a mountain of capital, and the financial architecture the state designed to fund it is built far more on faith than on public funds. The estimated price tag for this massive jungle capital sits between 32.7 billion and 35 billion US dollars, an amount roughly equivalent to the entire annual government budget of a mid-sized nation. Yet from the very beginning of the project, Indonesia decided that almost none of this capital would be drawn directly from the state treasury or national taxpayers. It was a bold fiscal stance designed to keep the sovereign debt ledger clean, but it immediately raised a massive logistical question. How do you build a multi-billion-dollar empire when you refuse to pay for it yourself? To insulate the national treasury, the Ministry of Finance drew a strict line in the sand, capping direct state fiscal exposure at exactly 20% of the total project cost. This restricted public funding exclusively to core administrative infrastructure, the presidential palace, water utilities, and basic ministerial office blocks. The remaining 80% of the entire capital city was left completely off the government's books. It was left to the untested waters of public-private partnerships, state-owned enterprises, and, crucially, foreign capital to find. To insulate the national treasury, the Ministry of Finance capped direct state fiscal exposure at exactly 20% of the total project cost, restricted to core administrative infrastructure, the presidential palace, water utilities, and basic ministerial offices. The remaining 80% was left completely off the government's books, handed to public-private partnerships, state enterprises, and foreign capital to find. By late 25, that search had produced just 4.3 billion US dollars, raised across 52 separate agreements. It sounds like progress, but $4.3 billion is only a small fraction of the $26 billion the maths actually required. Exit 3. Mortgaging Java to build Borneo. This brings us to the operational core of Indonesia's new funding strategy, an intricate financial pipeline designed to leverage the wealth of the old capital to construct the new one. The government realized that while international investors were hesitant to invest in a speculative jungle city, they were highly interested in buying into Java's lucrative, high-traffic infrastructure. The state's game plan quickly shifted from attracting direct greenfield investment in Borneo to systematically mortgaging the proven, cash-generating public assets of Java. The strategic vehicle executing this massive asset recycle is the Indonesia Investment Authority, known as INA. Unlike traditional sovereign wealth funds in the Middle East or Europe, which take domestic surplus cash and invest it in global stock markets, INA was built to do the exact opposite. Initialized with $2 billion US dollars and reinforced with a further $4.04 billion from the state budget, INA's core mission is to lease out mature, highly profitable domestic state assets to foreign institutional buyers, taking that upfront lease cash and immediately routing it to build the foundations of Nusantara. The specific assets placed on the global auction block are the critical networks that ordinary Indonesians rely on every single day. Consider the Trans-Java Toll Network, controlled by PT Jasa Marga Trans-Jawa Toll. Spanning 676 kilometers, this highway system commands 27% of the entire country's toll roads, collecting steady fees from factory managers in Semarang and traders driving to Surabaya. I may enter negotiations to cede a 35% stake in this premier network to the Abu Dhabi Investment Authority and the Dutch pension fund APG. The reality is striking. A portion of every single toll a Javanese driver pays will now flow directly to a retirement fund in The Hague. The privatization wave extends far beyond highways into the nation's strategic maritime and aviation gateways. PT Pelindo, which controls a massive 95% of the domestic container market, struck a $7.5 billion US agreement with Dubai Ports World, handing over operational control of key shipping terminals at Belawan and Tanjung Priok. Simultaneously, Kuala Namu International Airport, a major aviation hub, was transferred to India's GMR Airports Consortium on a long-term 25-year lease. Java's economic engines are being methodically unbundled and leased to international consortia. The underlying economic logic of this strategy is incredibly simple, even if the legal paperwork is immensely complex. Java's predictable, proven everyday cash flows are being aggressively converted into liquid upfront money today. In exchange for that immediate injection of construction cash, the Indonesian state is voluntarily handing away decades of highly dependable future revenue. The trade-off is clear, structural, and generational. Indonesia gets its brand new jungle capital city, but foreign institutional investors get the toll booths, the shipping ports, and the airport terminals. Axis T4, the gamble gets a deadline. But global institutional capital never arrives on developing market terms without demanding absolute legal protections. To convince international consortiums to deploy capital into the forests of Borneo, the executive branch knew it had to offer terms that were competitive on a global scale. This triggered a desperate drive to manufacture regulatory certainty, pushing the legal framework of the country to its absolute limits to appease foreign boardrooms. However, the state's eagerness to please international investors quickly collided with the rigid boundaries of the nation's founding legal document. To secure this international money, President Joko Widodo signed Presidential Regulation No. 75 of 24, offering unprecedented land rights extending up to 160 years across 2 continuous development cycles. Chinese state-backed consortia moved the fastest, pushing Chinese investment in Nusantara toward 70 trillion rupiah by mid-25. This spanned major toll concessions, a trackless tram pilot from China Railway and Norinco, and core telecoms infrastructure from Huawei. Meanwhile, the United Arab Emirates committed up to $10 billion through the Sovereign Wealth Fund pipeline. Then, on November 13, 2025, the entire legal foundation of these foreign investment models collapsed. Ruling on case number 185, Indonesia's constitutional court struck the arrangement down, declaring the 160-year upfront land grant entirely unconstitutional. The court ruled that it directly violated Article 33 of the 1945 Constitution, which mandates that the state must continuously monitor and control land use for the public good. Land tenures were instantly capped and staged, a maximum of 95 years for cultivation rights and 80 years for building rights, with the state holding the absolute right to refuse any future renewal. The financial fallout from this judicial ruling was immediate. Foreign consortia, suddenly facing intense regulatory uncertainty, recalculated their financial models and began demanding real returns of 15 to 18% just to stay at the table. But the concrete mixers could not stop spinning while international lawyers argued. To keep the flagship national project alive, the government forced its own state-owned construction firms, the Bumn Karya Group, to step directly into the breach. Firms like Wijaya Karya and Waskita Karya were compelled to absorb early construction risk, financing heavy civil works through massive corporate debt because private capital refused to enter. Predictably, under the weight of this forced development, the balance sheets of the state construction sector broke. Combined, the 4 major state firms posted a net loss of roughly 28 trillion rupiah in 25. Waskita Karya is the most severe casualty, buckling under 67.06 trillion rupiah in total liabilities. Its shares have been completely suspended from the Indonesia Stock Exchange since May of 23, and it now faces delisting while attempting to restructure its debts with 21 creditor banks. Simultaneously, Pembangunan Perumahan and Adikarya posted steep losses of 8 trillion and 5.38 trillion rupiah respectively, driven by the exact same structural mismatch, massive cash spent today for revenue promised decades later. This financial paralysis explains why, by late 25, Nusantara's actual population stood at just 147,430 people, an audience comprised almost entirely of pre-existing rural residents rather than relocated urban professionals. The grand relocation of the civil service has repeatedly stalled, with only 1,700 to 4,100 state staff ordered to move across the entire year of 26. As a direct result, the commercial districts, medical clinics, and modern services built to serve a new elite administrative class sit entirely vacant. The infrastructure is ready, but it has no customers to serve. Furthermore, the human cost of this delay is highly unequal. In North Penajam Pasir Regency, the capital's expanding urban footprint directly overlaps ancestral land held by the indigenous Balik and Pasir communities, home to roughly 20,000 residents. To secure basic utility services for an incoming government that has still not arrived, the state constructed the Sepaku River Intake Dam directly behind native villages. This choice permanently disrupted the traditional farmland and agricultural networks that had supported these indigenous communities for generations, shifting the immediate environmental burden onto those who have the least political voice. The scale of localized environmental disruption is visible from orbit. Between 2018 and 2023, over 19,600 hectares of primary forest was cleared, erasing native ironwood stands and sacred ancestral ritual sites. The indigenous population living closest to the rising capital is losing its land to build it, while remaining largely excluded from the high-skilled administrative and tech jobs the city is designed to create. Instead, they are left with low-wage, temporary construction labor in a localized economy where consumer prices and land values are rising far faster than their actual wages. Exit 5. What kind of precedent this sets? Indonesia's aggressive strategy of recycling mature public assets to finance a speculative greenfield capital city sets a highly controversial precedent. It is a radical departure from how other major Southeast Asian nations have historically approached the exact same structural problem. While every growing economy in the region eventually outgrows its colonial-era administrative capital, the financial mechanisms chosen to fund the exodus reveal fundamentally different philosophies about state debt, public infrastructure ownership, and who should ultimately carry the financial risk of nation building. When Malaysia decided to move its administrative hub to Putrajaya in 1995, it rejected privatization entirely. The federal government funded the project directly from the state oil company Petronas's balance sheet, keeping critical public transit and civil infrastructure off the commercial auction block. However, that centralized model is showing its own structural cracks today. Sarawak, which holds the vast majority of Malaysia's remaining oil and gas reserves, is actively challenging the 1974 Petroleum Development Act in the federal court. This legal challenge directly threatens the centralized funding model that built Malaysia's federal dreams in the first place. Vietnam selected a different path entirely for its premier urban redevelopment. To build Ho Chi Minh City's Thu Thiem Peninsula, the state completely avoided national budget exposure by funding major infrastructure through aggressive municipal land auctions and private concessions. While this model successfully kept the national sovereign debt ledger clean, it triggered years of intense land speculation, massive corruption scandals, and deeply bitter compensation disputes. It led to widespread public protests from local residents who were forcibly displaced by the state-run land auctions, showing that off-budget financing always carries a heavy social cost. Indonesia's response to its current funding crisis has been to centralize power even further rather than diversify its approach. In 2025, President Prabowo Subianto established Danantara Indonesia, a super sovereign wealth fund consolidating over 1,000 state enterprises and roughly $1 trillion in assets. In May of 26, a new development investment arm was carved out under Danantara, legally authorized to draw directly from the state budget for strategic, low-yield civil works, including Nusantara. While Danantara successfully raised $1.5 billion in its debut dollar bond in June of 26, it has yet to publish audited consolidated financials, creating a transparency gap that international credit markets are watching with extreme caution. What ties Indonesia, Malaysia, and Vietnam together is not the financial mechanism they chose, but the inevitable structural trade-off. Every single variation of the political promise to build a massive new city without asking current taxpayers to pay for it directly simply ends up forcing someone else to carry the risk instead. It might be a European pension fund, a heavily indebted state contractor, or an indigenous family whose ancestral land happens to sit in the wrong geographic path. Not everything in this story is fully visible yet. Indonesia's financial regulator, the OJK, puts total bank credit exposure to the Bum Karya construction firms at 46.21 trillion rupiah, but it has not disclosed which banks are carrying how much of that risk. Danantara's new development arm can request further state budget injections for Nusantara with no ceiling specified in the decree that created it, which means the true scale of Phase 2 remains unconfirmed. What is on the public record is this. Phase 2's legislative and judicial complexes carry a state allocation of 48.8 trillion rupiah. Phase 1 was backed by 89 trillion rupiah from the state budget, and the Trans-Java toll deal itself is public knowledge, even though the minimum traffic guarantees attached to it are not. For a project this large, that gap between what is confirmed and what is simply assumed is not a technicality. It is the difference between knowing who carries the risk and hoping someone else does. Back in Sepaku, a farmer whose rice paddy now sits behind a dam built for a government that has not yet arrived is unlikely to ever see a Trans-Java toll statement, an investment authority term sheet, or a Danantara bond prospectus. But the money moving through all three will decide the outcome. It determines whether the city rising near his village ever becomes more than concrete and promise, or whether Java's mortgage tolls end up paying for a capital that nobody in the end moved into. I am Hero the Hornbill, and this is the ASEAN Angle. If this episode gave you a new way of seeing the region, subscribe so you do not miss the next one. New episodes weekly, link in the description.